desire of people to gamble, and they gamble in stocks incidentally too. Day trading, I would say, very often came very close to gambling as defined.
In today's exploration, we are venturing into a territory familiar to every investor, the realm of mistakes. The motive behind this video is not just to revisit the blunders I've encountered in my own investment journey, but also to unearth lessons from them. By shedding light on these common pitfalls, I hope to arm both myself and you, my viewers, with the foresight needed to navigate the investment landscape more wisely. Before we dive into our main discussion, let's briefly outline the 4 companies that will serve as our case studies throughout this narrative. The first one is Zim, an Israeli shipment juggernaut that rode the high tide of COVID-19, benefiting from surging e-commerce and shipping rates, only to later face a significant downturn in its core metrics. Secondly, we have UNTC or Unit Corporation. Hailing from Tulsa, Oklahoma, this oil entity clawed its way out of bankruptcy, embarking on a journey of operational efficiency, cost reduction, asset sales, and shareholder returns through special dividends and buybacks. With a commendable management team known for its high insider ownership and astute capital deployment, UNTC represents a story of resilience. For those interested in a deeper dive, I've covered UNTC in a previous video, which you can find linked down below. Thirdly, we have PayPal. A titan in the payment processing arena, PayPal offers a broad spectrum of services, ranging from payment solutions and branded checkouts to digital wallets, along with other value-added offerings. And last but not least, we have Lifco, operating out of Sweden. Lifco is a serial acquirer specializing in niche markets within dental, construction, and demolition sectors. And it boasts a legacy of exemplary management, strategic capital allocation, consistent performance, and substantial insider ownership. With these companies as our backdrop, let's proceed to uncover the insights and lessons embedded in their stories. Let's explore 2 pivotal insights that every investor should consider. The first one is the pitfall of similarity. It's easy to fall into the trap of assuming that if one business model succeeded, another, seemingly similar one, will too. However, this overlooks the subtle yet crucial differences between companies. Take for instance comparing Dino Polska to Costco, because they share a scale economies model. Such a comparison ignores key factors like recurring revenue streams from membership fees in Costco's case, which Dino lacks, and the stark differences between the Polish and the US markets. This isn't about declaring one business model superior to the other, but highlighting the availability bias trap. It's a reminder to dig deeper than surface similarities and considering the unique elements at play. Secondly, let's dive into the law of holes and the ego's grip. Value investing isn't about finding undervalued stocks, it's about recognizing when you're wrong. The law of holes metaphorically suggests that if you find yourself in a hole or a bad investment, the wise choice is to stop digging or adding to your position and climb out. Our egos often compel us to hold on, hoping to avoid admitting a mistake, potentially leading to a greater loss. A personal anecdote: I learned this lesson through my investment in Zim. Despite its attractive valuation, Zim lacked a sustainable competitive edge, leading to a significant reduction in its earning power. Holding onto Zim until recently, I've seen an 80% decline from my initial investment. This experience was a stark reminder of the importance of humility and the willingness to pivot when necessary. It was a small experiment, influenced partly by an interest in the region, but the lesson was invaluable. Thirdly, let's aim for profit, not just being right. At the heart of successful investing, whether it's through value investing or hunting for 100 buggers, is a focus of the end goal, making money. It's easy to get caught up in the trap of wanting to be right, leading to confirmation bias where we cling to losing positions to avoid admitting errors. The true aim is wealth creation, not just proving a point. Recognizing when to let go and pivot your strategy is key to navigating the investment landscape profitably. Fourth, stepping out of your circle of competence. Understanding what you invest in significantly lowers the risk of costly mistakes. Both the Nomad Partnership and traditional value investing highlight the benefits of operating within your area of expertise. This lesson became particularly relevant to me with UNTC, a company where I leaned on external valuations rather than my own. For investments like these, where valuation is central, stepping outside your circle of competence can lead to miscalculations, especially in complex industries or during significant company transformations like divestments. Knowing your limits and acknowledging when you're venturing into unfamiliar territory can safeguard your investments from unforeseen pitfalls. Fifth, we have envy. It's human nature to compare our progress with that of our peers, but in investing, these can prompt risky maneuvers or lead to performance chasing, adopting strategies that are ill-suited to our goals or risk tolerance in an effort to keep up. While investing teaches us the virtue of patience and the importance of an independent, long-term view. Early in your investment journey, it's vital to resist shortcuts. Mimicking others' successes without fully understanding their strategies induces unnecessary risks. In investing, not all borrowing is financial. Borrowing conviction can be just as perilous. Let's jump into the sixth risk, which is the risk of leverage. While leverage can magnify gains, it also amplifies losses, potentially leading to significant financial distress. One of the beauties of investing is that inherently the odds lean in your favor, not necessarily in beating a benchmark, but in the sense that the worst outcome is losing your initial investment, while the upside is virtually limitless. Resorting to leverage or margin trading in an attempt to boost performance ironically evens the odds again, introducing a level of risk that can negate the inherent advantage of investing. This principle holds true for short selling as well. 7. The integrity of management. In the realm of value investing, the character and competence of a company's management are non-negotiable. No matter how promising a business model may appear, it's compromised if led by dishonest or inept management. Conducting through due diligence is essential to steer clear of businesses marred by questionable ethics or practices. The 8th mistake in my list is a premature sale. The quest for 100 buggers demands patience, a quality often in short supply. Many investors cut their journeys with winning stocks short, foregoing substantial gains. Distinguishing between a stock's price and its underlying value and holding steadfast to the latter can lead to remarkable growth over time that far outweighs the temptation of immediate returns. Following that one, we have verifying your investment thesis. The foundation of any investment decision should be a solid, well-researched thesis. Adhering to this principle ensures actions are guided by logic and updated information. A personal learning moment came with UNTC again, when I reacted to a price drop by doubling down, not because the fundamentals had changed, but merely in response to the market's fluctuations. This overlooked the fact that a substantial dividend payout had indeed already altered the company's intrinsic value. It underscored the importance of reassessing the original investment rationale, especially in the face of new developments. And 10th and last in this video is a trap of cheap stocks. The allure of seemingly undervalued stocks can often lead us astray if the business fundamentals don't hold up. The true investing isn't just about snagging bargains, it's about identifying fundamentally strong companies priced below their intrinsic value. This means assessing competitive advantages, financial health, and growth potential. ZIM serves again as a cautionary tale here, appearing attractively priced based on current performance, but cheap for substantial reasons tied to its fundamentals and long-term outlook. If you found value in the insights shared in this video and want to dive deeper, be sure to check out my full list of the biggest investment mistakes on my Substack, post linked below. Your journey to becoming a more informed and successful investor starts with understanding these common pitfalls.